like to introduce our leaders today. We have Carissa and Megan that are going to lead the seminar. Carissa joined Sisterson in 2011 after graduation from college. Her experience includes tax return preparation and review for corporations, partnerships, and individuals. Carissa is a member of the firm's emerging growth team and works with clients in a variety of industries with an emphasis on startup and technology companies. Megan, a manager in the firm's tax practices, joined Sisterson in 2015. Her experience includes tax return preparation for review for corporations, partnerships, and individuals. Megan works with clients in a variety of industries, including emerging growth, real estate, and service companies. She specializes in multi-state taxation and compliance, helping her clients determine their state tax exposure. So welcome, and I'll let you ladies get started.
Well, thank you. And I'm going to share my screen, ladies and gentlemen, just for this presentation. And any questions, please, again, feel free to put in the chat box. But Dee Palashchak is also on, and I'm going to skip down to her slide. And so you can see her face too. Dee Palashchak and Bill Richardson both head up the startup practice here at Sisterson. So there's, you could put a face to their name, but Dee is on the call as well. So with that being said, I'm going to hit the ground running. Thank you all for being here. And I think that there's a decent bit of information, and I welcome any questions as we go through this. We have had the opportunity to give this presentation quite a few times over the years. We work with a lot of the startups that come out of the Pittsburgh area. And it's a lot of fun to hear what you guys and gals come up with, and it's a testament to the Pittsburgh area how fast this industry is growing. So with that being said, I'm going to start out just by talking a little high level about the choice of entity type. And historically, the assumption is that most of you guys and gals have already formed an entity. And if you haven't, the discussion should be, is a little bit beyond this presentation. But part of the reason why we have this slide is in the startup world, the type of entity that you choose can affect your future. And there's pros and cons to the various types of entities. And I'm gonna pay attention to two different types of entities that are the most common: a C corporation and a partnership or an LLC. Oftentimes in the startup world, many entities, many startups begin as an LLC, which technically is a pass-through entity, which means that the entity does not pay tax, but rather the income and the loss gets passed out to its owners and reported on their personal tax return. There is some extra layer of complications to this because how you pass out those losses and income is something that is not applicable when you have a C corporation. And we'll get to that in a moment. A C corporation is an entity where the entity's income and loss is contained within the entity. So if you have income, the entity is taxed and pays the tax on the income. And then if you pass the income out to its owners, it comes out as a dividend. And there's that second layer of tax that a lot of people hear about for a C corporation. A C corporation can carry forward those losses. And I mentioned earlier about the fact that the entity is taxed. Those losses stay with the company until it is sold or wrapped up. And that's a topic that's a whole bunch of fun that we're not going to talk too much about right now. But oftentimes, startups either form as one or the other, an LLC or a C corporation. More often than not, entities form as a C corporation because it simplifies their tax work. Think of it. If you have an LLC, the entity's tax return needs to be completed before your individual tax returns can be done. So there's a layer of work that needs to be done before you can even do your personal returns. And so technically, investors don't often like investing in an LLC because if they have 50 different investments, they don't want to wait until all 50 of those investments get their tax returns done before they do their return. So what can happen, and I see this happen all the time, many startups start out as an LLC because they want to take advantage of the losses that are coming from the entity early on to offset other sources of income. We're going to talk about whether or not you can actually do that, but put a pin in that, we'll come back to it. So an investor would much prefer to invest in a C corporation because the entity pays tax in and of itself. You can, and this is a tax and money saving, not tax saving, this is a fees saving idea for you. If you are an LLC and you're required to convert in the future because an investor refuses to give you money if you remain as an LLC, there is this one-page election that you can file and be treated as a C corporation for tax purposes. So what you've just done is you've saved a whole bunch of legal costs because legally you could stay an LLC but be taxed as a C corporation for tax purposes, okay? So that's the first topic. Investors like to invest in a C corp over an LLC because they don't want to wait for the LLC's tax return to be completed. Having fun yet, guys? Sounds like you guys are having fun. So an LLC is a very common startup type of entity because individuals who start an LLC think that they are able to take certain deductions in the LLC. And more often than not, in your startup years, you're not making any money. I know you want to make money, but you're not often making money. You're spending more and you don't have revenue yet. So a partnership, let's say you have two partners. One of the partners is CMU, and they graciously gave you $100,000 to make your idea work. You are loving that $100,000 and you spend all $100,000. CMU owns 50% of the entity and you own 50% of the entity. And you have a loss of $100,000 because you've spent all $100,000 that CMU gave you. The big issue that I often see, I'm not going to ask questions because none of you guys are going to answer me. That's just the way it works in these Zoom calls. But the answer that I often get to the question that I'm about to ask, who gets those losses? The answer tends to be 50-50. You own 50% of the entity, CMU owns 50% of the entity. But unfortunately, tax law does not allow that. Here's why. Technically, because CMU is funding the loss, they should be allocated the loss. And when I see tax returns for people who aren't often familiar with the startup rules and the startup life, I see those losses split out 50-50. And then you as an owner, let's say you have a spouse who has $50,000 worth of W-2 income, and you say, this is nice. I have $50,000 loss from my entity. I have a $50,000 W-2 income from my wife or husband's job. I'm going to net them together and pay no tax. That's not how it works. Whoever pays for the loss gets allocated the loss. And I bring this up because this is a very common issue that sometimes people are counting on, and that's why they form as an LLC or partnership, and that's not often the case. So what you choose and why you choose it can affect your future, and there's opportunity to change it if you want to become a C corporation. Early on, we see a lot of LLCs, but staying an LLC or partnership, LLCs or partnerships, and then they eventually convert to a C corp if they're looking for that institutional investment. One more thing that I'd like to say about a C corporation, and this can be an absolute home run. So if you remember nothing else from this slide, remember this. Write this down, everyone. Section 1202. Code Section 1202 is something that was put in the law by the IRS a number of years ago, and their goal was to incentivize the creation of C corporations. Now, here are the rules for it. If you are a C corp and you're an individual who owns the stock of the C corporation for 5 years, not 4 years and 11 months, 5 years, and you sell that stock, each individual can exclude up to $10 million from federal capital gains tax. This is huge. So let me give you an example. Let's say there are two owners, like I had before, CMU is one of them, and you are an individual. And you both own 50-50. And you sell the company's stock for $20 million. Go you. Way to go. You rocked it. You each get $10 million, right? Because CMU is a not-for-profit, they don't get to take advantage of this exclusion, but you, as an individual, do. You get $10 million, CMU gets $10 million, but your $10 million is excluded from federal capital gains tax. What is the opportunity here? And why did I tell you to write this down? You might say, well, that's a long way off. Two things. Number one, you have to sell your stock, not your assets. So there are planning opportunities surrounding how you structure a deal. Second, it's 5 years. And if you can delay a sale by a week or a month, it could make or break the difference in your tax benefits. So this is something that we see people considering converting to a C Corp sooner rather than later to start that 5-year holding period that I was just talking about. It's not a reason in and of itself to do it, but if you're looking ultimately for institutional investors and you know you can't really deduct any of these losses because you're not funding the losses as a LLC, you may consider converting to a C Corp. The last item on this slide just talks about 83B elections, and it is only applicable if you have a C Corp or an LLC where your units vest over a period of time. Oftentimes, investors want you to stick around longer, so they require you to have your shares vest or your ownership vest over a period of time. This 83B election is something that legal counsel should help you with if they're familiar with startups. I mention it because you have 30 days from the date that you get your shares or unit in order to mail it to the IRS. And then second, a signed copy should be attached to your entity's tax return. Okay. Any questions so far? Anything that is coming up, please do share in the chat. I really do like it whenever there is some questions, so feel free to share. Payroll taxes, I'm going to hand over to Megan Rechenberg. she's going to jump in, and thank you for listening for the first piece.
Thanks, Carissa. So payroll taxes is an area where we see a lot of questions come up, at least in our practice. And I guess, one of the main things to consider as far as, being an owner of an LLC is that there's a difference between an LLC and a corporation. So if you are, a member of a corporation, you're an employee, you're getting a W-2. The W-2 has taxes already withheld on your behalf. The difference between the corporation and an LLC is that you're not getting a W-2. Your employees will get a W-2, but you'll get what's called a guaranteed payment. The major difference between a guaranteed payment and a W-2 or like a normal paycheck is the withholding of taxes. For guaranteed payments, the company isn't required to withhold for you. So you're responsible for that on your own. A lot of times you'll see people talking about making estimated tax payments. And what that is, instead of your company withholding tax for you and submitting that for you, you're on the hook for submitting that quarterly yourself. If not, at the end of the year, you could owe tax. So I think that's one of the major differences between corporations and LLCs. I will say that with an S corporation, which we didn't really talk about, but those also, those get W-2, so those are different than an LLC. Another area where we have a lot of questions typically is, what is the difference between an employee and an independent contractor? I think the biggest difference is, control. Do you have control of that person? Are you setting that person's schedule? Are you telling them when to come to work, where to work? Are they using, your computers, your tools, your things like that? Or are they holding themselves out for that kind of work for many different people? Do they have a business card that they're giving out in there? It's like an actual person that you're giving contract work to. One type that we see a lot that gets miscategorized are interns. A lot of times people consider interns as contractors, and that's not the case. I mean, think about it. An intern is somebody that you're telling them what to do, you're teaching them, you're showing them how to do things. So that's really an employee. I think where this comes up a lot is for, you know, startups that maybe just have some owners that don't have payroll, and they think, well, we don't really have payroll, but we want an intern, but they don't want to go through the process of, you know, setting up a whole payroll system. And that's where we see this come up a lot. Technically, you know, you should have payroll for that person. So that's something to keep in mind as well. There's reporting forms for independent contractors. There's actually a new form for this year. It used to be all reported on what's called a 1099 miscellaneous, but they now have a new form, the 1099 NEC. And that's where we're putting, you know, that miscellaneous income that is related to contract work now. So it's its own form. It's not included on the 1099 miscellaneous anymore. Something else to consider as far as PA goes is if you're paying somebody who is working for you in PA who might live out of state. So if somebody lives in Georgia and they're coming to, you know, PA to work for you and then they're going back. If you're paying that person or plan to pay that person more than $5,000 a year, there's a non-resident withholding requirement on you, the company, to withhold for that person. If you think about it, that person probably isn't going to, you know, file a Pennsylvania tax return if they're living in Georgia. Why would they? So this is how PA can get that tax, that 3.7% from that person. If you think, I mean, it's kind of hard to know if the person's going to be working for you a lot, it doesn't hurt to, you know, withhold for them. You know, at the end of the year comes, then you're playing catch up if you actually paid over $5,000 for them. So it's just something to keep in mind. As far as outsourcing payroll, our recommendation is to always outsource payroll. Do not try to do it yourself. It is not something that is easy. We know enough to be dangerous, but we even ourselves are not payroll people. It's good to have, you know, a company that does payroll. Sometimes our clients will say, you know, well, what about QuickBooks payroll? We don't typically recommend using QuickBooks payroll only because there are so many different quirky little taxes that come along with payroll taxes that QuickBooks just doesn't know about. I mean, even, you know, in our area, we have the Pittsburgh local tax, and then we have outside of Pittsburgh local tax, which are different percentage rates. So, you know, those are things that QuickBooks might not know. And if you have people working all over the country, it's going to be hard to make sure that everything is being accounted for. So we typically recommend going with, you know, a larger payroll provider that knows about those quirky things or has more experience with them. When you do have employees or contractors, there's something you should do first is get an I-9 for new employees or a W-9 for each independent contractor. These are basically the same thing, except one is for employees and one is for contractors. And it's just a form they fill out that gives them, you know, their address, their social security number, EIN. If it's a contractor, what type of entity are they? Things that you'll need to know in order to fill out those forms at the end of the year. We always recommend to get that before you pay them. Because again, if you get to the end of the year and you haven't talked to this person since January, it's going to be very hard to get that information from them. In some cases, you may not be able to get it. And, you know, these forms are required. So it's something that you should do in advance versus playing catch up later. Don't pay anyone before a system is in place. I mean, that's just kind of, you know, a good rule of thumb. You don't want to pay somebody and not know if they're an employee or a contractor. If they're an employee and you don't withhold tax, then, you know, you're on the hook for that. So it's always good to have a system in place first. And then just, you know, employee withholdings have to be paid timely, and there's different dates and things that go along with that. But, you know, there could be personal responsibility and liability related to that if they're not paid timely. Next slide, Carissa. Any questions on that? I guess you could put in the chat and we'll answer them later. The next slide is just about sales and use tax. And this is another area where we get a lot of questions. Are you required to collect and remit on your revenue? It depends. It depends on what you're doing. It depends on, you know, what type of industry you're in. There are lists that you can kind of go to and look and see if what you're doing is considered, you know, taxable for sales tax purposes. And we always recommend doing that before you start selling, because, you know, again, if you start selling and you're not collecting that tax right off the bat, then someone's on the hook for it. Who is it? Probably you. If you do have sales tax issues, you need to make sure that you have a tracking system in place. Different states have different sales taxes and all, you know, things like that. So you just want to make sure that you're, you know, reading up on things and making sure you're covering all your bases before you start selling. Are you required to pay on your purchases? Sometimes if you are buying something to put into your product that you're then going to sell to someone else and charge sales tax, you could be exempt for sales tax. There are exemption certificates that you can get and provide to your sellers in order to kind of bypass your tax and move it on to your client instead. And just, you know, sales tax audits are not uncommon. You know, we see them all the time. It's not something you kind of want to drop the ball on because it can be difficult to get out. And especially with things like if you're selling a company or getting acquired by someone and someone wants to do due diligence, this is a big thing that pops up. They want to make sure everything is in compliance. So this isn't something you want to take lightly. Again, questions in the chat. And then just, you know, as far as accounting goes, there's some things to consider. Who will keep your records? You know, there's a trade-off between doing it inside and having someone do it outside. One of the trade-offs is your time. You know, if you're coming up with the ideas and you're running the business, it might not be the best use of your time to also do the bookkeeping when, you know, someone else could easily do it, or you could outsource that instead. It's good to have, you know, books and records. You never know when someone's gonna, you know, want to invest in your company, especially as a startup. If someone says, hey, I might want to invest in your company, let me see the financials for the last quarter. You want to have those. You don't want to say, well, okay, let me get those together. And then, you know, 2 weeks later, you finally send them some financials. You want to be able to just print a report and say, here you go. In the beginning, is Excel enough? It could be. If you are listing everything out and you're categorizing things and making it clear and kind of setting it up in a financial statement kind of format, that's fine. The more you go, the more important it is to actually have some kind of system in place for that. Things to keep in mind are, you know, business versus personal expenses. Don't charge things to your personal credit card or vice versa. Don't commingle the cards or the funds. Save your receipts. Make sure you're writing the check number, the date, the business use, especially, you know, if you're taking someone out for dinner or something like that. And then keeping good records as far as your equity, your loans, things like that. Retain all of that stuff. We request it from our clients and we keep all of that. And I can tell you, anyone that is going to do your taxes is going to request that information as well. So that's something good to have. And then just again, do you need accounting software like QuickBooks? Yes, probably eventually you will. The sooner the better, the cleaner it'll be. The sooner you can start using a bookkeeping software, it's just easier. You don't have to, you have that information from the beginning. You don't have to worry about going back and backlogging information to get up to date. It's just in there from the beginning. I know QuickBooks has different programs that you can use as well. So, you know, you might start out lower. If you get inventory, then, you know, some kind of bookkeeping software is a must. So that's all I have as far as accounting goes. And again, if questions, in the chat. Back to Carissa.
Yeah. Thanks, Megan. Yeah, a lot of the stuff that Megan's talked about are good best practices to get into the habit of early on, especially getting in order before your tax returns are due, or even investors. Investors are all going to be asking for a lot of the pieces and looking into the pieces that Megan and I have talked about thus far. So due diligence is where a lot of people get dinged, and Megan mentioned, like, you don't want to be waiting a whole bunch of time before you get the information to your investor because it doesn't look good. And the only other thing that I'll say is you'd be quite surprised how inexpensive a bookkeeper or payroll companies are. It's their bread and butter. It's what they do. You don't need a bookkeeper on payroll, and you could have a bookkeeper once a month for 2 hours. You know what I mean? It doesn't need to be overly costly, but it gives you the peace of mind that you have your financials and everything in good order. So In the early stage issues, here are a couple additional things just to keep in the back of your mind if you've formed your entity. Even if you haven't formed your entity, these are things that you're going to have to focus on. Pennsylvania has a form called the PA 100, PA Form 100, and it's the one-stop shopping form in Pennsylvania. It's one of the few things they make somewhat easy, where you use this form before you have payroll. You register for your unemployment withholding numbers and your withholding numbers for PA. And then also, if you have to collect and remit sales tax to Pennsylvania, you will also use this form. I caution you, do not register for these various taxes until you actually need them, because if you register for it and you get an account number and you really don't have any sales, for example, you're required to file zero balance reports until you end up having to put anything on there, because Pennsylvania will issue you notices if you have an account number and you're not filing certain forms. Pennsylvania will also send you some welcome letters associated with that. Similarly, the IRS will send you your name and an EIN and everything else that you'll need to file with the IRS. So just keep all of that kind of stuff because there's account numbers on it. Convertible debt. Convertible debt is a common way that startups get some funds early on in their existence. Conceptually, a convertible debt or convertible note is where someone loans the company money in exchange for a future equity. And ultimately, it converts to equity at a stated price that's included in that convertible note agreement. Now, because this is a common thing, a lot of startups use this first before a true equity round. And it's like usually friends and family are involved in this. The savvy investor understands what I'm about to say, but sometimes the friends and family who don't often just give $10,000 to startups on a common basis might not be aware of this. As you have a convertible note, usually intrinsic in that note agreement is some interest rate, some stated interest rate. And in the Pittsburgh market, it tends to be somewhere between 6 to 8%. So let's say your brother gives you $100,000 because he's a really nice brother, right? And on that convertible note, it says 8% interest. Every year, if they gave it on January 1, $8,000 of interest income is accruing because interest is stated in that convertible note. What your brother might not be aware of is, even though he might not be getting any cash for that $8,000, that $8,000 interest will eventually convert into equity. And the IRS says that every year as that interest accrues, you are required to issue your brother a 1099 OID for that interest accrued. And your brother's gonna be like, wait a minute, I didn't get any cash, but I have to pick up income. Unfortunately, that's the case. And ultimately, you need to make sure that your investors are aware of this. And secondly, you need to make sure to issue this 1099 OID. It's due the following year after the interest is accrued by the end of January. So just keep that in mind, okay? Another early stage issue that is a little bit further down the road, but the use of stock options to incentivize employees or advisors. Again, you guys are strapped for cash early on. And so stock options are often a way that you can incentivize people to stick around because there's some vesting schedule associated with it. Or, you personally think that you should have a bigger stake in the company the longer you stay. There are different types of stock options out there, and they have different tax implications, which is beyond the discussion of this presentation. But I bring it up because you just need to be proactive in this area, okay? It's something that your legal counsel will be able to talk to you about if they have experience with startups, and whoever your accountant is will be able to answer those questions as well. The last bullet point on this slide is also an area where we see tax returns who've been prepared by tax preparers who aren't familiar with the startup world done incorrectly. The IRS says, they say a lot of things, but in this case, the IRS says that if you are a startup and you have not begun business, you are not allowed to take certain deductions, with the exception of research and development. And you might say as a startup, well, everything that I do is research and development. Stop, Carissa, there's no reason to go down this path. Well, unfortunately, that's not actually the case. Legal costs, if to form the entity, if you're paying legal costs to capital raise, if you've got rent or market research, a lot of costs might be considered R&D to you, but not in the eyes of the IRS. So the IRS says that you're not allowed to take a deduction until you begin business unless it's R&D. Now, you don't lose that deduction, but what happens is those costs get accumulated. They get capitalized, and they get totaled together until you begin business, which I'm going to talk about in a moment, but they get accumulated. And then once you do begin business, those costs get spread out over 15 years. You don't lose them, but you just don't get the benefit of the deduction as early as you might think. Now, the thought of beginning business is quite nebulous, unfortunately. It's not always cut and dry, but theoretically, when you could begin becoming capable of generating revenue is the date that you're open for business. So some people who are developing a web app, the release date on the Apple Store or Droid. If you're developing a service and you needed to get certifications in order to be able to provide that service, that date could be it. There's a lot of different ins and outs on how you could determine when you begin business, and it's when you're capable of generating revenue. Other times, it's just a matter of when your first sale was. When was your first sale? That's when you begin business. But there are some complications in that year that you do begin business with the tax return prep. And so that's the point of this piece of the discussion. Okay. So I mentioned research and development, and I'm going to skip one of the slides and I'm going to come back to it. But there are a couple credits that are very common in the startup world. And the first credit that I'm going to talk about is the research and development tax credit. And there are three categories that qualify for this credit. Wages, if you're paying someone wages for the proportion of time spent doing R&D. So let's say you pay someone $100,000, to keep my example easy, and that 60% of this person's time is spent doing R&D. $60,000 qualifies for the R&D tax credit. The next category is if you're outsourcing the R&D, and it must be outsourced to the United States. It cannot be foreign to qualify. If you are outsourcing the R&D for the proportion of time spent doing R&D, it's usually 100 because you either outsource it or you don't for the R&D piece. That qualifies for the credit, although it's limited to 65% of the amount. The last category that qualifies are the supplies that are consumed in the R&D process. So for someone who is developing a piece of software or an application, you usually don't have very many supplies, if any. But for someone who's developing a widget or some physical product, the scrap, the pieces that go into the prototype, all that kind of stuff qualifies for this R&D tax credit. So wages, supplies, and independent contractors. Those three categories qualify for this R&D tax credit. Now, there's a federal tax credit and there's a Pennsylvania tax credit. The federal tax credit is calculated as part of the entity's federal tax return, okay? And it's included all within there. Now, if you are a startup, you might say, I'm not making any money, so what good is a tax credit? You're right to an extent, but sometimes these tax credits are looked, people who acquire you are looking at these tax credits, so they could use them. It might be limited on how fast they could use them, but they might use them. But the IRS realized that startups weren't making any money early on, and if you're a startup and you're a small business and you qualify, you can make an election to offset the future employer portion of the Social Security tax for your W-2 wages. So rather than carrying that credit forward until you pay tax, you can make this election and you can use this tax credit sooner than you otherwise would have. It's a way for you to monetize this tax credit, and it's real money in your pocket. I mean, you get around 6.5% of the total of those categories that I was talking about. It's free money. You're already spending the money. You might as well get a tax credit while you're at it, right? So the federal credit is part of the federal tax return. It will carry forward until you owe tax at the on the entity, unless you make this election. And if you make the election, you simply need to coordinate with your payroll company to make sure you're taking advantage of the credit that you've gotten. Simple as that. Pennsylvania also has a tax credit. Now, this credit is calculated based off of an increase year over year in R&D expenditures. So that means you at least need to be in existence for 1 year and have R&D costs before you could qualify. But what makes the Pennsylvania credit, yes, I'm a nerd, guys, don't judge me. But what makes the R&D credit so awesome is that it can be sold for cash. And you can get around 80 to 90 cents on the dollar, and there's a very ready market out there for it. So let's say you get a $100,000 R&D tax credit in Pennsylvania. You could sell it for $80,000 or $90,000. If you're not going to pay tax anytime soon, this is like cash in your pocket a whole lot sooner than you otherwise would have. So it's just something to think about. And if you're not taking advantage of the R&D tax credit and you think you're doing R&D, you might want to get on that because, again, it's free money. The last thing that I'll talk about with this R&D tax credit is documentation is really important for these, by employee, by project. You know, keeping time records in a perfect world is ideal, but that doesn't always happen. Just be sure you're keeping good enough records so that when your tax preparer asks you these questions, you'll be able to answer these questions. Okay. The next tax credit that I wanted to mention is the Keystone Innovation Zone tax credit. And this credit is based off of an increase year over year in revenue. Now, in order to qualify for this credit, you need to be located in one of 2 geographic zones inside of Pittsburgh. There's the Greater Oakland and the Pittsburgh Central. The hard part about this tax credit is you could be inside the zone in 100 block, and across the street you could be outside of the zone. Like, for real, it's kind of crazy. Pennsylvania has one map that's interactive that you pull up your address on Google right next to you, and you look at this map, and it's a shaded area to see if you're inside the zone or you're not. And then the Greater Oakland zone, I have like a Word document. You can do a Control F, like search for your address to see if you're inside the zone. What I'd like you to be aware of, though, is sometimes this is a reason for some startups to move into a zone. Some areas of CMU are inside the zone. Bakery Square, for example, is inside of a zone. Alloy over in the North Shore is part of the zone. So there's just a bunch of different places around the Pittsburgh area that you could be inside the zone, and you might consider getting a space there in order to qualify for this tax credit. Again, this is a Pennsylvania tax credit. Both the R&D Pennsylvania tax credit and the Keystone Innovation Zone, or the KIZ tax credit, are due by September 15th, the applications for it. You need 2 years of R&D expenses for the PA R&D credit. You need 2 years of revenue for the Keystone Innovation Zone tax credit, all right? The question that we often get for the KIZ tax credit is, does grant revenue count? A lot of our startups are getting grant revenue from the DoD or Department of Energy, all of those various government agencies. Yes, it qualifies, and that's oftentimes where you can see really large dollar amounts. Lastly, this PA KIZ tax credit can also be sold for cash. So again, 80 to 90 cents on the dollar, the maximum credit's $100,000 you can get for this, but it's still free money. Again, you're doing what you're doing anyways. You might as well get a tax credit while you're at it. And it really, really means a lot to some of our startups and gives someone an extra month or two, couple months of runway when necessary. The last tax credit that I want to mention has actually been suspended after 2020, but I bring it up just in case Pennsylvania brings it back, which I have some contacts that think they might eventually bring it back. The job creation tax credit is a credit that's only in Pennsylvania, and it's used to incentivize the creation of jobs inside of PA. Why do I bring it up if it's not around? Well, keep an eye out for these types of credits, because what happens is you actually have to apply for this credit before you do the hiring. So if you've already hired a large number of people and then you say, oh, there's a jobs credit available, it's too late. You can't get this tax credit. I'm not going to go through the mechanics of this credit at this point because it's irrelevant, but why I bring it up, like I said, is just to keep your eye on these types of incentives. And we do this a lot for our clients, but it's a matter of paying attention to what incentives exist for your industry and then making sure that you're planning as you continue to grow. So with that being said, that is our presentation. I think over the years, we've really tried to streamline the pieces that we talk about and spend time on. We're a little bit faster than normal because we often get questions throughout the presentation. So I'm really hoping that you guys have some good questions. But one thing that we talk about is economics first, taxes second. And, you know, there's a lot of things you can do right the first time, which is the name of our presentation, doing it right the first time. That it might cost you more early on, but you would be amazed the tax savings in the long run. Something like that 1202 exclusion, that $10 million. If you can do some tax planning surrounding that, it means so much to you in the future. Investors, if they're digging into your books, you want to make sure that you've got things under control so that when they ask these questions, all you have to do is be like, already thought about it. This is your answer. We pay a lot of attention to making sure to stay up on the issues out there. Sales tax is a huge issue, especially with the Wayfair case. States are hungry for revenue, especially in light of the COVID situation going on right now. So they're sending notices out left and right, and sales tax is one of the areas where they're going to be able to generate that revenue a whole lot easier sometimes. With that being said, I would love to open the floor for any questions. Megan, Dee, if you have any comments on something we've talked about that you want to elaborate on, feel free. But those are the presentation pieces. And here's our contact information, which you can also reach out to Allison as well if you have any questions. I would love to chat. Thank you all for your time and your thoughts, and I look forward to some of your questions.
Thanks, Carissa.
Allison, I'm not able to kind of see any of the questions on my end. Do you know if there are any questions at the moment, or feel free to unmute yourself?
Currently, there aren't any questions in chat, but does anybody have any questions? Guess we have a quiet group today.
Yeah, hello, I have a question.
Hi, Neil.
Hey, what are considerations for something like a remote first company? So I'm a CMU, I graduated from CMU. I'm working with my advisor on a project and someone from my old grad cohort, and my peer, the person who is my age who graduated with me, she's moving to California. My advisor's in Pennsylvania, he's a professor, and I'm in Missouri with a location to be determined. I established an LLC in Missouri because, I assumed I would be here for most of 2021. And, but I'm not really too sure where I'll end up afterwards. What's the recommended procedure for that? Because we don't have any revenue. We probably won't have any revenue until like mid-2022, according to some estimates.
So I think, Neil, it becomes a question of where are you doing business? And each state has different rules on the determination of what is doing business. Just because you incorporated your entity in a particular state does not necessarily mean you have an income tax filing in that state. There might be an annual filing report required wherever you incorporated, but that doesn't necessarily mean you have an income tax return. My recommendation to you is to pay attention to where your payroll is. For example, if you're paying the person who's in California, California has a very low threshold on payroll to say that you have a filing requirement. And don't quote me on the dollar amount because it changes every year with fluctuation, but somewhere around $55,000. If you pay someone $55,000 and they have payroll, you know, W-2 and all of that kind of stuff set up, you have a California reporting requirement. So that's just one example where paying someone in another state can give you income tax nexus in another state. That's the first comment. The second thing is if you are looking to pay someone like a W-2 wages, you're going to need to make sure you're getting your payroll set up in all of those states. If you're paying someone W-2 wages and you're setting yourself up for payroll, you are now on the radar for income taxes because those departments talk to each other. Payroll is different than income taxes. Payroll taxes on your wages versus income taxes on the income or loss of your entity. So just be very cognizant of that. And I would recommend exploring the various roles in each of the states that you're located in, your people are located in, especially if you're paying them and or if they're an officer or own the entity. Okay.
Thank you.
That was a good question. Any follow-up? Any other questions there?
I think I would be jumping the gun if I asked questions. We just have a less than $55,000 budget right now, and we're paying 1099 throughout the year, working part-time on the entity. So I think those considerations for after she moves to California and after I leave Missouri will come to the forefront near the end of 2021. So I appreciate your answer to my question. I'll write down your response.
Sounds good. Thanks, Neil. I think there's another, oh, it looks like Allison posted a survey link in the chat. Does anyone else have any questions?
I have one. I have a startup we incorporated we're C Corp from 2019 at this point, and I guess we have basically we incorporated it's a couple reasons, but anyway, at some levels just to apply for like some of the SBIR grants, and so but we have had like zero revenue, zero everything, right? So we're all just kind of but the company exists. I guess for 20 tax year. We set it up, our fiscal, like we incorporated, I think December 26, 2019, we set up our fiscal year as calendar year. And yeah, so I did taxes, filed federal taxes in, with basically zero everything in 2019. And that would be the same this year. I've done that with, and I don't know how bad this is to say, I did it with like the TurboTax, like business, for like C Corp. But I figured like there's literally like no action anywhere. I mean, like how reasonable does that sound to you, especially as we're looking now to have to deal with 2020?
So I would pose the question, you mentioned that you got some SBIR funding, or did you already apply for it?
Just apply. We haven't been awarded any funding yet.
And you haven't, and so you've not spent any money for the entity yet? It's just been formed. You have no, do you have a balance sheet or a cash? A checking account? We
created a checking account just because again to apply for SBIR they required one, so it has $1 and maybe $1 and a cent, $1.01. So that's it. Yeah.
High rollers you are.
Yeah, there's no debt. I like to say, hey, our startup has no debt.
Well, it's a good problem to have, I guess. I think that, so if you were to tell me you were a partnership, technically you wouldn't have to file a tax return if you didn't have any activity. But because you're a C corporation, there's a technical filing requirement, so you should continue to file a C Corp tax return. If you have no income and you have no expenses, it sounds like the method to which that you've decided to file seems appropriate. Couple cautions, even though you have a zero tax return, you may have attachments like the 83B election that I mentioned if you guys are giving ownership out. So making sure that you're attaching certain things. But if you have any other specific questions, it sounds like your question was, is it okay if I use TurboTax? And to me, that sounds, yeah, go for it. Why would you spend money if you don't have to? But make sure that you're not missing certain pieces and attachments if there really truly is something that needs to be done.
Okay. Yeah, sounds good. Yeah, thank you. Appreciate it.
Yeah, it's a good question.
I had a question, but I wanted to first put a warning on the previous questioner. I was in a similar situation. I had an LLC, but we filed 0 returns for a while, and it was no problem at all. And then when we went on payroll with the LLC, we were in the city of Pittsburgh, and they all of a sudden found out that we existed several years before and demanded quarterly payroll withholding returns going back several years. No problem, they were all 0s. We didn't get in any real trouble, but they harassed me a lot until I filled out a whole bunch of the same page with a bunch of 0s. So
yeah, Sean, I'm so happy you say that. And it's hard sometimes whenever I make these comments it's super general, and I have to be super general, but you are right. Pittsburgh, and this is something that Megan hit on earlier about those nuisance taxes, those little nuisance forms that QuickBooks Payroll just does not understand exists. That is one of those forms, the Pittsburgh city tax. Any partnership or pass-through entity, sole proprietor, anyone who's pretty much doing anything in Pittsburgh, the city of Pittsburgh, you have some registration requirements. And to John's point, those 0 balance returns weren't that big of a deal. You got a slap on the wrist. Okay, cool. But you still had to do it, and then you get all these notices, and it's an annoying thing. So there are oftentimes issues there, but if you're not doing any payroll, you're not really doing any work, you should explore, really, do you have a filing requirement?
yeah, I was just going to say, be aware that may be coming. Pittsburgh may not know you exist, but as soon as you pay payroll and pay payroll taxes to them, they're going to say, wait a minute, you owe us all these past returns that are all 0s anyway. Just an annoyance. I guess my question was, there were a number of comments about tax credits. There was the R&D tax credit, and there was another one, or accrued losses, I think. I just formed a C Corp, as you know, I had an LLC before. I just formed a C Corp beginning of this year. What should I be doing today? We are going to have small amount of payroll. We aren't going to have sales revenue. So what should we be doing today to take advantage of those kinds of tax credits?
Did you form in 2020 or did you form in 2021?
I think technically we formed in December of 2020.
Okay, and do you have any expenses that you could push into 2020 at all?
None, 0.
None, okay.
Yeah.
So the R&D tax credit in Pennsylvania is based off of an increase year over year. Having some small amount of R&D expenditures in 2020 would benefit you, so far as you'd be able to apply for this R&D tax credit sooner. Now, I can't tell you to make up expenses, but I can assume that you personally put some money into this entity at some point, perhaps for a supply that can qualify or something like that. So there's some tax opportunities there if that is the case. The KIZ tax credit is a credit that's based off your location. So if you choose to locate yourself inside of one of these zones, the sooner you do that, the sooner your first year can qualify. Now, I'm not sure if 2020 is even in the cards, because I'm not sure where you are doing business yet. But if you were to be in the zone in 2020, you should reach out to the coordinators, the KIZ coordinators, to let them know that you're in the zone. And by letting them know, just by letting them know that you're in the zone, it basically gets that process started to where you have a base year. If you have any questions on, if you're in the zone or anything, let me know. I can always follow up. I can provide some contact information for someone who brokers by the purchasing and selling of these tax credits, if that's also something you're interested in.
Mm-hmm.
And then lastly, what can you do now for any of these tax credits? I would make sure that you're getting a process in place to track if you're paying someone, what proportion of their time qualifies for R&D. In a perfect world, time records are ideal. If you're applying for grant revenue, like the SBIRs and anything else out there, they often require that anyways. So you might already have that underway. So those were a couple just tidbits, but are you looking for something more specific? Because I can keep going.
No, I think that's a great start. Yeah, we are definitely applying for, we've had one small business grant, and we're applying for some bigger ones. So hopefully the
Great.
C Corp will actually have some money soon.
That's awesome. That's awesome. And what's really cool about the C Corp is this is a cautionary tale for those of you guys who are LLCs as well, and who are looking for government grants. The exercise of converting legally from an LLC to a C Corp requires you to get a new identifying number with the IRS. And oftentimes our startups are okay with staying legally as a C Corp, or staying legally as an LLC and making that one-page election to convert to a C Corp. The problem is when you apply for these government grants, you apply under one specific EIN. And if you legally want to convert to a C Corp, the novation, the moving of that grant to a new EIN is extremely time-consuming and difficult, so much that the people who administer the grants often refuse to do it. So you have to wait until the grant is run its course. It's just a cautionary tale that I have. So if you're looking for institutional investors who may want you to become a C Corp and don't want to do that one-page election, becoming a C Corp before you apply for these grants is not a bad idea, but it depends on every fact pattern is different. And Sean, you're nodding. It looks like that might be something that you have experience with.
That is the reason that I currently have an LLC and a C Corp by the same name. I had an LLC with a grant. You cannot change where that grant is going. I needed a C Corp, and so the lawyers were saying I should just convert, but I couldn't. So now I have two entities, and hopefully the LLC will die in 2021. That is my goal, but for now I have two. It's a pain.
Yeah, and in that situation, the legally staying as an LLC and converting to a C Corp for tax purposes, sometimes it's just not sufficient. So Joe Moore, thank you for your question in the chat. It says, can you give a few more important accounting steps to take for a sole proprietorship LLC? First of all, as a sole proprietorship LLC, all of the income and loss flows through your personal income tax return. You do not file a separate tax return if you are the only owner, and you're not electing to be treated as a C Corp. I'll add that caveat since we've just been talking about that whole thing. A couple things that Megan's mentioned from an accounting perspective, I think are really important, making sure that you're categorizing your income and your expenses, your ins and outs. What is truly income versus equity versus loans? Your expenses, making sure they're categorized accordingly. And, again, I'm a nerd to the nth degree. So if you're using Excel, using a sum if function to get the information totaled and grouped together so that whoever prepares your tax return, whether it's you or someone else, has a nice and neat income statement to put on your tax return.
I think something to consider too is if you're filing the sole, Carissa mentioned you file it as part of your own tax return, so it's a Schedule C. Something that the Schedule C doesn't request is a balance sheet. So if you think at any point in the future that you're going to take on a partner and move into like a more of a partnership instead, it's good to be keeping a balance sheet the entire time. So you have, records that go back. So that first year for your tax return, you have something to report on your balance sheet. It's hard to recreate the wheel if you get so far into it. So it just makes it easier if you're kind of tracking things the entire time, even if it's not required to be reported on the tax return. And I think even some of the credits request, some financials as well. So if you're looking into that kind of thing, you might consider that as well.
Yeah, Megan, that's a great point. The KIZ, the Keystone Innovation Zone tax credit, does request a balance sheet, and so too does the R&D tax credit in Pennsylvania. So they want to see a balance sheet. Even if it's not prepared, you have to do a pro forma. So that's a very good point. From a sole proprietorship too, like getting QuickBooks or something like that sooner rather than later is ideal. I really am a big proponent of what Megan said. Getting everything in order early on prevents you from having to go back and fill in the gaps from the start of business. So those are our thoughts. Is there there anything specific you were wondering about, or just some good general accounting guidance like that?
Yeah, that's really helpful. Thanks for the generic guidance.
You're welcome, Jill. Any other questions?
Well, maybe I'll add on then. Well, what about payroll within this context? Is that something that is relevant to a sole proprietorship?
Megan, do you want to take that one, since that was the topic of your...
Sure. I mean, it can be if you're going to have employees. If you're just paying yourself, not really. You're just going to be kind of subject to that same estimated tax conundrum. So,
Right.
you know, how much are you going to profit from the business for the year, and then figuring out how much tax you might owe on that amount, and then paying it in quarterly to make sure you're not getting penalized. And then as far as, you know, if you have employees, it's kind of just like any other business. You would want to find a payroll company and kind of run it through that.
Yeah. Awesome.
Independent contractors, by the way, if your business existed in 2020, those forms should have been filed. Those 1099 NECs that Megan mentioned earlier should have been filed by the end of January. So if you haven't filed them yet, you should probably get on that. You have to issue 1099s to someone, an independent contractor. You pay $600 or more throughout the year. That includes accountants, attorneys, anyone who is not a C corporation or not for profit. So that's another good practice to get in, especially early on, because that's already due. And then Sean mentioned this too, as a sole proprietor, if you're operating in Pittsburgh, there's that Pittsburgh city tax, regardless of whether or not you have payroll.
Oh, I guess I should have mentioned too, the those reporting forms like the 1099 miscellaneous and NEC and OID. Some of them can be done online, like the NEC and the miscellaneous can be done online, or you have to mail carbon copy paper to the IRS. They won't accept, you can't just go online to Google and print them out and fill them out. They have to be on carbon copy paper if you're mailing them. So, you know, I guess our recommendation would be, if you can find somewhere to do those online, do it. If not, you have to, I don't know, I guess you could order the forms from the IRS. I just don't know the process for that. Usually our clients, we can send them to them, so that's not a big deal, but just something to keep in mind if you aren't going to have the ability to file those online.
The other alternative is if you go to staples.com and you can get like 50 or 100 of them, which you of course need 50 or 100 of them as a sole proprietor, right? And there's special ink that you can use that's on those forms as well. So that's an option too.
Wow. Right. Hope to avoid that.
Right? Like, who needs 50? I mean, they're not super expensive. It's just a pain. Like, who needs 50 of them when you can just, you need 2 or 3 sometimes.
Cool. Thanks again, guys.
Welcome, Joe. Anyone else? This is fun stuff. At this point, it's the heat of busy season on our end. So we're getting a lot of questions from clients regarding like the PPP and everything else that it was associated with it. What was interesting, and I'll just add this little nugget of knowledge, that many of my startups actually ended up benefiting from the PPP because they have a lot of funding that has been put into payroll that came from equity or debt infusions of the past. And because they had payroll, they qualified for that PPP loan, which will ultimately get forgiven in most all cases. So they got what I guess would be considered a non-dilutive infusion of cash. And it's been pretty cool for many of my startups that you might think would not exist going forward. So sometimes people who avoided setting up payroll got bit in the butt because they didn't have the payroll to support a decent sized PPP loan. So again, I understand startups, cash is king, and you're not wanting to set up payroll, and who could have thought that this pandemic would ever occur? But it's just one of those situations where people who ended up having payroll really got some extra money to make their entity go. Well, if there are no more questions, I welcome anyone to use our contact information, which I'll pull back up. If you want to reach out and shoot us an email if you have anything or you're wondering about. It's always a pleasure to come and speak. I wish I was there, but obviously that's not the case because I like to feed off of the audience's questions and facial expressions when I say something goofy. But I wish that everyone has a happy and safe year, and whatever their endeavor is, good luck to you. I look forward to seeing perhaps your names again out there. And if you have questions, feel free to reach out. But thank you for your time and good luck. And I hope you all rock it out there.